How to analyze stocks like Warren Buffett, using Buffett's famous 4 pillars. Analysis. Today, we are going to go through a screening method value investors such as Warren Buffett, Peter Lynch, and Charlie Munger go through that reliably finds you winners among the thousands of losers. This method is, of course, known as Warren Buffett's famous 4 pillars. These 4 pillars are: understand the business/circle of competence, competitive advantage/moat, management team, and finally, valuation/intrinsic value. First pillar, understand your circle of competence. The first step to finding a great business is to define your circle of competence. This simply means to invest into companies you understand. This can be as easy as making a list of your skills, what you spend your time on, and what you spend your money on. For example, if you spend a lot of time playing video games, you will probably understand a video game company better than you would a biotech company. The benefit to investing into companies in your circle of competence is that you already understand how the company operates and makes money without reading their annual report. First pillar continued. Understand the business. Once you have found a company within your circle of competence, briefly skim through their most recent annual report, 10K. In the business section of the annual report, management will perfectly outline what the business is, what they do, and how they make money. After reading this, you can decide if the business is something you're interested in or not. Pillar number 2, moat/competitive advantage. What is a moat? Buffett says, a truly great business must have an enduring moat that protects excellent returns on invested capital. The moat he talks about refers to a competitive advantage that makes the business unique and better than others in the same industry. In a literal sense, a moat protects a castle from oncoming attack. For example, Apple has a competitive advantage over other competitors like Pixel and Samsung. When picking businesses, it is critical that they control the market over competitors and can increase their market share in the future. When a company's ROIC, return on invested capital, is high, it gives value investors like Warren Buffett an indication that they have a strong moat. Pillar number 3, management team. Warren Buffett uses 3 approaches to value a company's management team. First approach, shareholder letters. If the company issues shareholder letters, read through them starting with the oldest letter to the present letter. By doing this, it tells you a lot about the management's execution and how they control themselves in market crashes. Second approach, earnings transcripts. By reading a company's earnings transcripts, you get a good feel on their future goals and aspirations. In addition to this, during the Q&A, you can judge the 2 main characteristics of a company's management, which are skill and integrity. Third approach, proxies, tells us how the management team are compensated, how they can earn bonuses, and how much stock they own. Ideally, you would want modest executive salaries and performance-based bonuses. Also, you need to make sure top executives, such as the CEO, has a decent stake in the business, so their wealth is directly tied to how well they can grow that company. Pillar number 4, valuation/important metrics. After ticking off the first 3 pillars, we move on to analyzing the company's financials. Important metrics to look at include return on invested capital, above 10%, indicates moat. P/E ratio, compared to competitors in same industry. Debt to cash flow, less than 5 is good. Price to free cash flow, below 10 is good. Current ratio, above 1.5 is considered great. Current assets compared to current liabilities, to gauge if they can pay off their current debt. And finally, make sure the business has stable earnings per share, revenue, free cash flow, and equity growth. Pillar number 4, valuation/intrinsic value. To determine if a company is currently undervalued and to determine a buy price, Warren Buffett calculates the business's intrinsic value, which is done by the discounted cash flow analysis. To see full example of this, check my last video. American Express stock analysis. Conclusion: by going through this simple screening method, Buffett's 4 pillars, value investors such as Buffett himself, Peter Lynch, and Charlie Munger can find winners among the thousands of losers. To see full example of this approach, check out my American Express analysis. Thanks for watching, subscribe for more, and feel free to leave some video ideas in the comments for the future.